Unbiased Reveal channel. Welcome to the Deep Dive, the shortcut to being well-informed. I'm Peter.
And I'm Jenny.
Okay, so we're diving into quite a week. A real white-knuckle ride defined by volatility.
Definitely.
Our main topic today, that sharp crypto market correction. A real gut check that hit on October 29th, 2025.
Yeah, things moved fast. In less than a day, what was it, $63 billion just vanished from the total market cap.
Exactly. Dropped from around $3.81 trillion down to $3.75 trillion. Just like that.
And Bitcoin is just, well, stuck. Sort of consolidating around $113,200. Can't seem to break that $115,000 ceiling.
And the immediate fallout from that drop, a huge wave of forced selling, right? Liquidations everywhere.
Hundreds of millions in leveraged positions got wiped out.
So the big question we're exploring today, based on the sources you shared, is this just a healthy pause, a correction before the next big bull run?
Or is the foundation maybe starting to show some cracks? That's what we need to unpack.
Right. Our mission here is to look at the big picture.
Yeah.
The macro stuff, like the Fed. What the institutional whales are doing.
Yeah. And also those long-term bullish ideas, the structural things that are still brewing underneath all this noise.
Okay. But before we really get into the weeds on all that.
Quick mention, if you want access to some of the reports and data platforms we might touch on, check the description. We have the best referral link in description.
Okay, perfect. Let's start at the top then. The macro puppet masters, as you call them, and the witty weather report.
Yeah. Well, you have to start with the Federal Reserve. Doesn't matter what crypto's doing internally, the Fed sets the weather.
True. And the big event is the Federal Open Market Committee meeting, the FOMC. That's dominating everything.
Absolutely. And what's really interesting, or maybe amusing, is how certain the market seems to be.
You mean about the rate cut?
Yeah, and a 99.9% expectation of a 25 basis point cut.
Okay, quick reminder for everyone. A basis point BPS, that's 1/100%. So 25 BPs is a 1/4% cut.
Right. So it brings rates down a tiny bit, but they're still relatively high. 375 to 400 basis points, or 3.75% to 4%.
But Jenny, despite rates staying pretty high, the feeling in the market, the consensus view, it's almost euphoric. Like the Fed is about to unleash the crypto bulls.
That's exactly where the sarcasm comes in. The story is that this is it, the return of easy money. You've got Wall Street folks shouting about insane wealth creation coming our way.
Because they expect more cuts after this one.
That's the bet. December, early next year, more cuts. The easy money taps opening up.
Okay, but hold on. If easy money is basically guaranteed, why are those same people already talking about a hangover?
Yeah, that's the conflict, isn't it?
Does the market really trust the Fed to stick the landing here, or is it just, hoping for the best while bracing for impact?
It feels a lot like the late 90s again. The golden sentence here seems to be, enjoy the party as long as it lasts, and then prepare for a hangover.
So party now, pay later.
Pretty much. Analysts are saying, look, risk gets mispriced when there's tons of liquidity, so yeah, maybe insane wealth creation now, but sometime late next year, expect a horrific 30, maybe even 50% correction across tech, crypto, all the risk assets.
Because of all the debt building up.
Exactly. The structure of it signals danger down the road. So the current bet is make money fast on the way up, then try not to get caught when it turns.
Wow. Okay, so massive economic conflict brewing, short-term party, medium-term pain.
Yeah.
But there's maybe some good news balancing that out. The Trump-Xi meeting.
Yeah, that's the other big macro piece, a potential positive catalyst if they reach an agreement, which is sort of expected.
That boosts U.S. stocks.
Generally, yeah. Global stability is good for equities. And since Bitcoin still trades pretty closely with risk-on assets like the S&P 500...
It could follow stocks higher.
Right. So you've got this positive political possibility bumping up against the Fed uncertainty, classic mixed signals for the market.
Okay, that's the big picture, the short-term jitters. Let's zoom in on the mechanics of the actual drop. The liquidation roller coaster. Why did $63 billion disappear so quickly?
It was all about those cascade liquidations. In just 24 hours, over $500 million in leveraged positions got forced closed.
And mostly longs, right? People betting the price would go up.
Over $365 million of that was longs getting liquidated, wiped out.
Can you break down leverage simply for anyone listening who hasn't used it?
Sure. Think of it like this. Leverage is like running really fast towards a cliff edge. You feel like you're flying.
Until you look down.
Exactly. The moment the price moves sharply against your bet, you get that margin call. It's like gravity suddenly kicks in. You have to sell immediately at whatever the market price is.
And that forced selling pushes the price down even faster, triggering more liquidations.
Which pushes the price down more. It's a cascade. That's why you get those really sharp, sudden drops.
Okay, technically speaking then, where are we now? Bitcoin's testing a key level.
Yeah, a really critical flashpoint. The $112,500 support level. This one's important.
Why that level specifically?
It's a zone where the price consolidated before, found support. It's also a bit of a psychological line in the sand.
So, if Bitcoin breaks below $112,500,
Right.
what happens then? Where are the next potential floors?
Well, losing that level could trigger even more liquidations. The next stops could be around $109,600.
Okay.
Or, if the selling pressure is really intense, potentially down towards $104,000.
Why those levels?
Because analysts see big clusters of existing long positions sitting there waiting to be liquidated if the price drops that far, so it could accelerate the downward move again.
And on the upside, still stuck below.
$115,000, that's a psychological ceiling right now. It's a very tight range, lots of tension.
So with all this uncertainty, traders are playing it safe. Protection mode.
Totally. Capital preservation is the name of the game right now, more than making big directional bets.
But here's a key point from the analysis.
Yeah.
That money isn't necessarily leaving crypto.
Right. It's often just moving into stable coins, cash sitting on the sidelines. Analysts are calling it a dry powder economy.
Meaning there's fuel ready for the next rally.
Exactly. The money hasn't left the building, it's just waiting, holding its breath. That actually suggests a lot of underlying confidence that eventually the market will turn up again, and that cash could propel the next move higher when sentiment shifts.
Okay, interesting. What about the big players, the whales? Their movements have been a bit confusing lately.
Very ambiguous. Take Sequans, for example. They're a known corporate holder. They moved 970 Bitcoin.
Worth about $111 million.
Yeah, current prices. They moved it to Coinbase.
And usually moving coins to an exchange means...
Typically, yeah, the market reads that as bearish, like they're getting ready to sell. But, and this is the conflict point, Sequans hasn't said anything. They haven't confirmed a sale.
So it could be something else.
It could just be them, I don't know, reorganizing how they hold their assets, maybe for security reasons or regulatory compliance stuff. We don't know.
And that silence feeds the uncertainty.
Precisely. It fuels doubt when the market's already nervous.
But we do have a counter story
Mm-hmm.
from BitMine.
Yes, BitMine Immersion Technologies. They're actually the largest institutional holder of Ethereum. They hold something like 2.8% of all ETH.
And their stance is different.
Completely different. Aggressively bullish, actually. They specifically raised cash to buy the dip. They bought another 77,055 ETH just last week.
So one whale potentially getting cautious, another one actively buying.
Exactly. That's why the market is just chopping sideways. Big money sending conflicting signals.
Okay, let's zoom out again. Forget the short-term panic for a moment. Let's talk about the big picture trends, the structural stuff that suggests maybe this volatility is just noise. The great tokenization tsunami. The supercycle idea.
Right. This is where the long-term bullish case gets really interesting, especially for Ethereum.
Tom Lee at Fundstrat had a powerful analogy for this.
He did a really profound historical comparison. He likened what Ethereum is doing today to what Wall Street did back in the 70s.
After the U.S. left the gold standard.
Exactly. Back in 1971, the dollar wasn't backed by gold anymore, so it needed a new foundation, right? Wall Street basically invented a whole new financial infrastructure, things like certificates of deposit, futures markets to secure the dollar's global role.
Okay, so the analogy is?
The analogy is that today, traditional finance, the entire world of finance, is rebuilding everything onto a blockchain.
Digitizing assets, process.
Everything. And the data suggests that around 70% of that rebuilding activity is happening on Ethereum.
So Ethereum becomes the new foundational layer for finance.
That's the argument. And if that Ethereum supercycle plays out, if this structural shift keeps maturing,
the price targets get pretty wild.
Analysts are talking about ETH potentially hitting $21,000 per token eventually. This isn't just hype about price, it's about the fundamental plumbing of global finance changing.
And this tokenization idea is moving beyond just crypto circles now. Larry Fink, CEO of BlackRock.
Still talking it up. He's saying owning assets like crypto, or gold for that matter, is basically a hedge against optimism, meaning a hedge against governments messing up, currency debasement, that kind of thing. He calls them assets of fear, which is a pretty powerful endorsement from the head of the world's largest asset manager.
And we're seeing actual adoption from huge traditional companies, too.
Yeah, look at Western Union, massive global money transfer company. They're launching their own stablecoin, USDPT, and they're doing it on the Solana blockchain.
What does that signal to you?
It confirms the shift. Old school finance companies realize they have to adopt blockchain tech, or, as one source put it, they might as well close up shop.
And adding to that momentum, Securitize, a platform focused on tokenizing real-world assets, RWAs.
And links to BlackRock.
Right. They're going public at a $1.25 billion valuation.
That tells you institutional money sees massive potential in tokenizing RWAs, things like real estate, private credit, you name it. It's not just about digital coins anymore.
Okay, what about regulation? That's always been a hurdle.
Seeing some positive signs there, too, at least potentially. In the U.S., there's the Clarity Act. It's bipartisan crypto legislation. The expectation is it could pass relatively soon, which would bring some much-needed, well, clarity.
And maybe the most explosive point, sovereign nations getting interested.
This one is fascinating. France's parliament is actually debating a bill to buy 420 Bitcoin.
Now, 420 BTC isn't a huge amount in the grand scheme of things.
No, not in itself. But think about it relative to what sovereign wealth funds typically hold in crypto, which is often zero or close to it. That 420 BTC represents maybe 2% of Bitcoin's circulating supply, if you think about it in terms of potential scale.
So the signal is more important than the amount.
Exactly. Imagine the market impact if even a small fraction of the world's sovereign wealth funds started allocating just a tiny percentage to Bitcoin. It's a potential game changer.
Okay, but we promised the unbiased reveal. We have to cover the dark side, too.
Absolutely. Because while the West seems to be leaning towards adoption, the crackdown narrative is still very real elsewhere.
Like in China.
China's sticking to its zero-tolerance policy. Just recently, a Beijing court sentenced 5 people to prison.
For what?
For illegally moving money out of the country using crypto. Over $166 million worth of Chinese yuan converted into USDT, the stablecoin, to get around strict currency controls.
So crypto being used to bypass regulations.
And worse. In India, the enforcement directorate there is reporting that a lot of the crypto scams and illegal loan app schemes ripping people off are being run by Chinese nationals. They estimate huge amounts like Rs 28,000 crore, that's roughly 3.4 billion US dollars in crime proceeds, are being laundered by converting them into crypto to move the money illegally.
Wow, so you have this stark contrast. Huge institutions adopting the tech for legitimate finance, while it's also being used for serious crime and regulatory evasion.
That's the reality. Institutional adoption and structural shifts on one side, persistent regulatory crackdowns, and criminal misuse on the other. Both are happening at the same time.
So wrapping this all up, what does it mean for you, the listener, trying to make sense of this?
Well, we've laid out the tension, right? The market's clearly in a short-term correction. It seems driven mostly by leverage getting flushed out and nervousness about the Fed.
But the underlying long-term picture looks different.
The structural trends, tokenization, institutional adoption like RWA, even potential sovereign interests that all suggest the bigger bull cycle might still be very much intact, structurally sound, you could say.
So this current pause, this dip, it's maybe not a failure of the whole crypto idea, but more like a strategic pause, a repositioning.
That seems to be a plausible interpretation. And you look at other assets, like gold. There's that old saying, gold leads, Bitcoin follows. Gold's price action might be hinting that Bitcoin's next big move isn't far off.
CryptoQuant had a take on this too.
Yeah, they basically concluded that what we're seeing looks like a relatively small correction phase for crypto overall.
And they expect.
They think a strong surge in altcoins is likely later in the cycle, probably alongside some intense market overheating before it eventually tops out.
So we circle back to the whales. We see institutions signaling buying the dip, like BitMine did.
But we also see caution, like the Sequans transfer potentially signaling selling pressure.
Which leaves the open question for you listening. Does this current market dip feel more like a scary moment where retail gets shaken out?
Or is it maybe the final boarding call before that potential supercycle really takes off? What stands out most to you in all this?
Let us know your thoughts. And again, if you want to dig into the data points yourself, we have the bet referral link in description.
Welcome to subscribe to my channel and like this podcast so that I can continue to make more podcasts.